So, just a few months back, Cleveland-Cliffs CEO basically called their financial results unacceptable.
Yeah, I remember that. The stock definitely reacted.
Exactly. But now, their latest earnings report, it paints a totally different picture.
A real turnaround story, it seems.
It really does. So today, we're doing our deep dive into Cleveland-Cliffs' second quarter 2025 results.
Right. And we want to unpack the strategic moves, the market shifts, everything that's driving this pretty dramatic change.
Yeah, help you pull out the important nuggets from their financials in that earnings call. Okay, so to really get this comeback, let's rewind a bit. Remember Q1 2025?
Oh, yeah. It was tough.
Definitely challenging. They reported an adjusted EBITDA loss of, what was it, $174 million.
Mm-hmm. And adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization. It's a key measure, right? Shows operational profitability.
Exactly. And their CEO, Lourenco Goncalves, he didn't mince words. He flat out called the Q1 results unacceptable.
And the stock dropped pretty significantly after that. Wasn't a great look.
Not at all. A difficult period for them, for
Yeah,
sure.
it absolutely was. But like you said, Q2, a completely different story. I mean, really significant recovery.
Next significant are we talking?
We saw adjusted EBITDA swing back into the positive, hit $97 million for the quarter.
Wow. Okay. From a $174 million loss.
Yeah, that's a $271 million improvement, quarter over quarter. Massive.
That is impressive. What else stood out?
Well, record steel shipments, too.
Oh,
4.3 million net tons. That's, a lot of steel going out the door.
Uh-huh.
And revenues climbed to $4.9 billion. That's up from $4.6 billion in Q1.
So shipments up, revenue up, EBITDA positive. What about the bottom line, the net loss?
Still a loss, but much smaller. The adjusted net loss narrowed quite a bit, down to $247 million, or $0.50 per share.
Okay, too.
Compared to $456 million, or $0.92 per share, in the first quarter.
Yeah.
So yeah, really compelling shifts across the board.
Okay, here's where it gets really interesting for me. How? How did they pull off such a rapid shift from, unacceptable losses just 3 months earlier to this turnaround? What was the strategic secret sauce?
Well, the CEO, Goncalves, he basically said, our second quarter results demonstrate that the footprint optimization initiatives announced a few months ago are already generating a positive impact.
Footprint optimization. Okay.
Right, both on costs and revenues. He specifically mentioned steel unit costs were down $15 per net ton compared to Q1.
Just 1 quarter.
Just 1 quarter. And he expects those improvements to get even better in Q3 and Q4.
Yeah.
So this isn't just like trimming budgets randomly.
Well, it sounds much more targeted.
It really is. Think of it as a strategic surgical strike on the parts of the business that just weren't competitive. A real focus on high-margin core operations. It's kind of a blueprint other older industries might look at.
So not general cost cutting, but like you said, surgical. Targeting those underperforming non-core assets that really dragged them down in Q1. Can you give us some specifics? What did they actually do?
Oh, yeah, they were very specific. They took several big steps to optimize their operating footprint.
Yeah.
For example, they fully idled a few steelmaking facilities.
Which ones?
Okay, so Riverdale's compact strip mill that was shut down because its costs were just too high, uncompetitive. Then Conshohocken's plate finishing facility idled because it just kept underperforming.
Right.
And Steelton's rail facility. That one was idled mainly due to, and I quote, excess rail imports and continued underperformance.
Rail imports. Interesting.
Yeah, the CEO actually called out Nippon Steel specifically, saying they were selling rail through the Section 232 tariffs, those national security tariffs.
Uh-huh. So the tariffs were meant to help, but maybe had an unintended consequence there.
That seems to be his argument, yeah.
Yeah.
That it allowed some imports to undercut them. Anyway, just those 3 moves, Riverdale, Conshohocken, and Steelton, are expected to save around $310 million a year.
Wow. Okay. That is a substantial chunk right there. So they weren't just trimming the edges, they were also restructuring core steelmaking.
Exactly. That's the other piece. In their core operations, they idled the Dearborn blast furnace, the BOF steel shop, and the caster there.
So where does that production go?
It's not just disappearing. It's being replaced by restarting the Cleveland No. 6 blast furnace. It's a strategic shift.
And the savings from that move?
Expected to be around $90 million annually. And then there's the mining side, too.
Ah, right. They're iron ore mines.
Yep. They fully idled the Minorca mine and partially idled the Hibbing mine, both in Minnesota.
Why those?
Mainly to rebalance working capital, basically.
Yeah.
Free up cash that was tied up in inventory and use up some excess pellet inventory they'd built up in 2024.
Makes sense. And the savings there.
Estimated at about $45 million a year. So you add it all up, these operational changes. over $300 million in expected annual savings.
And they expect the full impact when?
Second half of this year,
Huh.
2025. And what's really key here, I think, is that these actions, they're all geared towards efficiency. They're not expected to hurt their ability to serve their main customers,
Yeah,
automotive service centers.
right. So it's about focus.
Totally. The strategy is basically get out of markets where they weren't making money, like rail, specialty plate, high carbon steel sheet. Focus on becoming a more cost-competitive producer of the areas where they can win, not trying to be everything to everyone anymore.
Okay, so these internal shifts are huge, clearly. But Cleveland Cliffs, they don't operate in a bubble, right?
Not all.
A big part of their confidence, it seems, and their whole outlook rests on the bigger picture, specifically trade policy and tariffs. So what does this mean for, like, American manufacturing overall? It sounds like Cliffs is really betting big on a certain future.
They absolutely are.
Yeah.
And you really can't separate it from their strategy. The leadership there, particularly the CEO, has a very, very strong view on trade policy.
Okay.
He said repeatedly he believes the Trump administration shows strong support to both the domestic steel and the domestic automotive sectors.
Right. So they see tariffs as a positive thing.
Definitely. They see tariffs protecting domestic manufacturing, jobs, national security, and they expect that whole trend to continue. They talk about promoting the resurgence of the American auto industry. And Cliffs positions itself very specifically within that. They call themselves the American Steel Company designed to supply domestically produced steel to the American automotive industry.
So built for that specific purpose, essentially.
Pretty much. And they point to examples suggesting it's working. Imports of light vehicles from Japan and South Korea down over 30% so far this year.
Interesting.
And U.S. light vehicle production forecasts have actually been revised upward recently.
Yeah.
So this isn't just, political talk from the CEO. It's really fundamental to their business model.
So the operational changes and this trade focus, they go hand in hand.
Exactly. They're betting that a made-in-America auto supply chain helped by tariffs is the way forward, and they're restructuring to be the go-to steel supplier for that. But there is a nuance here. While they like the tariffs protecting their markets, the CEO has raised concerns about something else.
Okay.
Specifically, dumped pig iron imports coming from places like Brazil, Ukraine, South Africa.
Pig iron. That's a raw material for steelmaking, right?
Yeah, exactly. And he argues these cheap imports give an unfair advantage to some of their competitors, specifically the EAF mini mills.
Right, the electric arc furnace guys who mostly melt scrap. Different process than Cliffs.
Totally different. Cliffs uses iron ore from their own mines. It's an integrated process.
Yeah.
So his point is, look, if we're protecting domestic industries, let's have a level playing field for all domestic producers, especially since, as he puts it, Cliffs feedstock is 100% made in USA.
Gotcha. So it's a call for consistency and trade protection.
That's the argument, yeah.
Yeah.
It's an important angle for them in that whole trade debate.
Okay, so optimizing operations, betting on trade wins. That's a lot already. But it sounds like they're also getting rid of some external baggage. I heard something about an onerous contract that was costing them. Is that right?
Absolutely right. That's another huge piece of the puzzle for their future profitability.
Yeah.
It's the upcoming expiration of what the CEO literally called an onerous slab supply contract.
Onerous. Okay, tell me about it.
It was a 5-year deal to supply steel slabs, those thick rectangular pieces of steel, mainly from their Indiana Harbor plant. And they were supplying them to a competitor's joint venture, ArcelorMittal Nippon Steel Calvert.
Supplying a competitor, okay.
Yeah. And the contract ends December 9th, 2025. So coming up.
What was so onerous about it?
The pricing. The price they got paid was tied directly to the Brazilian FOB index.
FOB free on board. So the price of slabs leaving Brazil.
Exactly. And that Brazilian price just tanked, partly due to global markets, partly tariffs elsewhere. But at the same time, U.S. prices for hot roll coil, that's the finished steel cliffs, could sell those slabs as we're actually going up.
Oh, wow. So they were stuck selling cheap slabs when they could have made more selling finished steel.
Precisely. It created this big negative margin for them on that specific product. The CEO said it was a negative contributor to EBITDA, just dragging earnings down.
So the good news...
The good news is the contract ends in December, and they are not extending it. That termination alone is expected to free up about $500 million in annualized EBITDA starting in 2026.
$500 million
Yeah.
just from letting that contract die.
Yep, because they can shift that production, those sales, to much higher profit products. It's like unlocking value that's been just trapped for 5 years.
Mhm.
And beyond just, shedding those old burdens, Cliffs is also actively reshaping its future investments. There's a Butler project, for example.
What's that one?
It's an induction reheat furnace. They describe it as highly accretive, meaning it should really boost earnings. And it's got backing a $75 million grant from the Department of Energy
DOE grant. Why?
because it directly supports U.S. energy dominance goals.
Hmm.
See, Cleveland-Cliffs is the only producer in the U.S. of GOES that's grain-oriented electrical steel.
Ah, the stuff needed for transformers, right? The grid.
Exactly.
Yeah.
And demand for GOES is, in their words, red hot. So this isn't just some random project. It's a very calculated investment in a specialized high-demand product critical for energy infrastructure. Then you have the Middletown project. That one's actually changing.
How so?
The scope is shifting. It's going to be a substantially lower cost project now. They're planning to rely more on readily available fossil fuels instead of massive amounts of hydrogen.
Interesting pivot. Why the change?
Seems to align better with the current administration's maybe more pragmatic energy priorities and realities. And finally, they've decided not to pursue the investment in the Wheaton transformer plant anymore.
Okay. Pulling back on that one.
Yeah, and that saves them $50 million in capital spend just this year, 2025. So you see these moves, investing smart in GOES, adjusting Middletown, ditching Wheaton. It's all about streamlining, focusing capital where it makes the most sense.
Okay, let's try and bring this all together then. We've got operational shutdowns, a renewed focus on auto, the boost from tariffs, shedding that bad contract, targeted investments. What does this actually mean for their financial road ahead, their guidance, their investments?
Yeah, their updated full year 2025 outlook really reflects all these moves. It shows a real laser focus on efficiency and cash flow.
So numbers-wise.
Capital spending, CapEx, is now guided lower, around $600 million. That's down from $625 million before.
Okay.
SG&A expenses, selling, general, and administrative also trimmed down to about $575 million from $600 million.
Having costs where they can.
Right. And they're sticking to their target for steel unit cost reductions, still expecting about $50 per net ton lower costs compared to 2024 overall.
But wasn't there something going up?
Yes. Depreciation, depletion, and amortization, or DD&A. That's now expected to be higher, around $1.2 billion, up from $1.1 billion.
Why is that?
It's mainly because of those idled facilities. They have to accelerate the depreciation, basically write off the value of those closed assets faster. It's an accounting impact of the restructuring. And liquidity looks pretty solid. As of the end of June 2025, they had $2.7 billion in total liquidity. That's a decent cushion.
Gives them flexibility.
It does, and it's been very clear. Their plan is to use 100% of their cash flow to pay down debt. Strengthening the balance sheet is a top priority.
That makes sense after a tough period.
Absolutely. Plus, they mentioned getting unsolicited interest people approaching them about buying some non-core assets.
Really? Like what?
They didn't specify which ones, but they said it could potentially unlock several billion dollars of potential value.
Several billion. Wow.
Yeah, and any money from those potential sales. Also earmarked straight for debt reduction, so they're serious about deleveraging. So wrapping up their outlook, they're pretty optimistic. They anticipate meaningful EBITDA improvement in the second half of 2025 relative to the first half.
Building momentum.
Exactly. And they expect results to kind of reset higher in 2026 as all these factors become fully baked. It really looks like a strategic repositioning aimed at getting back to sustained profitability and strong cash flow, moving away from that unacceptable label pretty decisively.
So to quickly recap our deep dive today, Cleveland-Cliffs has undeniably made a huge strategic pivot. Just months after their CEO called results unacceptable, they've pushed through some really decisive operational changes, streamlined their business, and are positioning themselves hard to benefit from trade policy shifts and those key market opportunities, like automotive and electrical steel.
Yeah, it's a comprehensive overhaul, all aimed at getting back to strong profits and generating solid cash.
Exactly. And, it really raises a broader question, doesn't it? As Cliffs repositions for this resurgence of the American automotive industry, emphasizing domestic production, well, what other industries might we see making similar shifts? As global supply chains keep realigning and countries increasingly focus on national security through maybe more economic independence.
That's definitely something to think about. Where else might we see this kind of strategic shift play out?
Something for you, the listener, to ponder as these big economic and strategic currents continue to swirl.